I guess now if we start to kind of think ahead for what planning can people be doing throughout the year, what things can they look ahead to kind of get the results they want? Something I even found myself telling people during tax season this year is that anyone could file your tax return, but if you want the results that you want and you're hoping for when you file your tax return, you need to be doing the planning all year. For example, I guess walk us through, these are some things that even have changed with the Secure Act, like inherited IRAs. Talk us through like some things that people might notice with something like that.
In some of these areas, we have the ability to prepare and plan and think ahead and kind of what is going to be the result of this event. So one thing that changed recently with the Tax Cuts and Jobs Act, or even more recently with the Secure Act, is when you inherit a retirement account from a spouse or a family member, or you're just listed as a beneficiary of a friend's IRA. The timing of when you have to start taking those out, depending if that was a spouse or not, are all changing. There's different rules on whether that can be rolled over into your own inherited IRA, or if that now has to be a non-spouse IRA and distributed over 10 years. There's what's called required minimum distributions, often known as RMDs, and those have to be happening either recurring annually or over a 10-year period. So there's a lot of things that have to happen whether you like it or not, sometimes based on age, sometimes based on the account. Yeah, things that we have to be considering.
Yeah, no, that's helpful. Another thing too, kind of along that same vein, is just trust returns, just knowing and understanding the trust that you've created. And when you put money into that, then how that's going to be taxed. Is that going to create or cause another tax return to need to be filed versus just your personal return? So I think this is even something that we're kind of seeing more of because of, again, just people inheriting assets or, moving funds into a trust.
Yeah, out of like the 186 or almost 190 returns we
Mm-hmm.
prepared, I'd say a dozen of those are entity related, either small businesses, a couple not-for-profits, but the rest of those are trusts.
Mm-hmm.
So whether that's a special needs trust or like someone's estate where they passed away and now the assets are being held for the family members, we had a number of those this year that we had to work through. For a number of them, it was the very first time, and we had to explain the whole process of we're going to be preparing a return based on the income and the funds that are still being held for your benefit.
Mm-hmm.
Each beneficiary will receive a K1, which is kind of like a W-2. It summarizes here is your share of the income and deductions, and whether that's reported on the trust tax return that has to be filed or on your tax return.
Mm-hmm.
Yes, for a number of clients, that was a very new process. In addition to, mom and dad are no longer here, or this family, we no longer have this family member. So
Mm-hmm.
they had the benefit of receiving these inheritance, but also kind of the additional, I don't want to call it burden, but
Mm-hmm.
responsibility of filing a tax return.
Yeah. And so sometimes I think people can be surprised and they just don't realize it. So yeah, no, that's helpful.
Some things that are changing will be we have a number of clients who are young families, but their children are now near the end of high school, getting ready to go to college. So the child tax credit, and this has changed over the years, but the child tax credit is currently $2,000 per child, and that reduces your tax dollar for dollar up to $2,000 if you don't exceed certain income thresholds. But once your child is the age of 17 or greater, that changes from 2,000 down to 500. So a $1,500 difference just because your child is a year older than 16.
Mm-hmm. I guess kind of along the lines with kids, education credits, what there do people need to remember?
Yeah, so not in addition to the child being greater than 17 and that child tax credit decreasing, they're maybe going away to school. So we'll have tuition and education credits, which you may qualify for. For many of our clients, their income exceeds a certain threshold, whether it's, I think this year it was 170 or 180 for this coming year. When your income exceeds a certain threshold, none of those college tuition education related expenses qualify for a deduction. So they're kind of in no man's land. So
Okay.
one where we're not where you can still get a benefit and it's not phased out at all based on your age, the child's age, income levels, any of that is uh, college savings plans or 529s is the tax code.
Hmm.
You can set that up. If you're an Illinois resident, you can use the Illinois plan, write directions, and fund future college education expenses. And every dollar that you put in there is reduced by 4.95%, which is the state tax level. So you can put in, so if you put in 10,000 if you're single, or if you put in 20,000 if you're husband, wife, you would save $495 or $990 on your state tax return.
Yeah, no, that's helpful. Another age that I guess we kind of think of is kind of these RMDs, like the age 70 and a half it used to be, but now it's changing. Maybe just talk through, a little bit of those details.
Yeah, so when we use that word required minimum distribution or RMDs, the IRS is saying these are accounts that are strictly retirement. This is not your brokerage account or your checking account. These are retirement accounts. So think 401k or 403b if it's through an employer, or traditional IRA or Roth IRA if it's individual. Certain accounts have this RMD, and some accounts don't. So the Roth IRA does not, but all the others do. And when you reach a certain age, based on the calendar and your birth dates, you have to start taking distributions out of these. It's roughly 4-ish% per year, and that will increase, but it's over your lifetime. And once you reach a certain age, in this case, used to be 70 and a half, now it's 72. There's talk about it in the future, maybe being adjusted back to 75. You have to take out roughly 4% per year from that account. And the reason for that is it was growing. You got the benefit when the money went in, it reduced your taxes or your taxable wages. It's grown what's called tax deferred, meaning you were never taxed on it over the years. But now when you take that money out, it will be considered taxable income and you pay tax on it at whatever rate you're currently at. So oftentimes, if we're retired, we're maybe at a lower rate than when we were working. So it kind of works out.
Yeah, and that's a lot of the planning that really we try to get ahead of, to say, well, and to answer that question, are you going to be at a lower rate? Some people won't, some people will. And so what are the opportunities there?
Yeah. And then what's leading up to between when I retired and when these RMDs have to start, there's some planning windows that we call them, some opportunities to move money or convert money at really low rates. So, yeah, a lot of planning opportunities, but certain things have to happen based on your age, based on the date on the calendar, all of that. So, what has to be done and when is what we're looking at when we're planning.
Mm-hmm. Another one with timing. So this is kind of one, safe harbor. So again, people have maybe income early in the year and they'll ask the question, what do I need to do? Kind of that safe harbor versus estimated payments. What should they be doing? I think there's, a couple little rules or a rule that you kind of use to help people understand if they need to be. Maybe share a little bit about that.
Yeah, so this would be clients that have a balance due. Maybe their withholdings aren't sufficient or don't cover all their tax liability completely. What we want to make sure is that they reach what's called safe harbor thresholds. So the way to think about that, it's either 90% of the current year tax or 110% of last year's tax. And you want to do that in certain times throughout the year. Make sure that you've had enough either withheld from your employer, from your retirement accounts, or possibly even making estimated tax payments quarterlies throughout the year.
So that's making sure that you've paid in at least 90% or 110% of those amounts.
Exactly. So even if there's a remaining balance due, you've reached what's called that 90% threshold. You're now safe harbored, meaning that remaining balance due can be paid before or when you file your tax return, but there won't be underpayment penalties and interest accrued or incurred on top of that.
Okay. One of the last ones here is like rental property, things like that. Anything there specific that people need to remember?
Yeah, we have a number of clients who have owned rental properties